Thank you so much for joining. In today's video, we start looking at a portfolio management case. So I want to show you how to calculate risk and return for a portfolio. And we start simple. So we assume your portfolio has only two assets or two underlying portfolios. It's the same. Whether your portfolio has two separate assets like single stocks or different underlying portfolios. So we assume you're an investor and you decide to invest in two assets, or as said before, portfolios, to create your own portfolio. We assume the first one, your first asset could be Apple stocks, has a 10% expected return and 16% risk, measured by standard deviation. And the second one could be Microsoft or Volkswagen or any other share, has a 20% expected return and a 30% risk, again as measured by standard deviation. You can also use variance as a risk measurement, but standard deviation is a bit more convenient because it has the same magnitude as your return. So I do prefer standard deviation. You could also do the same example and say, okay, we are not looking at Apple and Microsoft, we are looking at portfolio one here. We are looking at S&P 500 and here MSCI Emerging Market Index. How we calculate risk and return mathematically is the same, whether you talk about single assets that make up a portfolio or individual portfolios that make up a new portfolio. We assume you invest 80% in asset number one and 20% in asset/portfolio number two. One information that we need is the correlation between these two assets. We do two cases. The first one is correlation of 0.8 and the other one is a correlation between those assets of 0.2. So correlation is how those assets move together. If it's 1, they move identical. If it's -1, they move in opposite direction, and then you have the full range from -1 to 1. If it's 0, it's completely uncorrelated. Okay, let's start with portfolio return. RP equals weight 1 expected return 1 plus weight 2 expected return 2 equals, and we know the weight. Here the weight is 80%. So we have, write it down here, we have 80% times, for our first one, our expected return was 10%, plus 20% times expected return is here 20%. That's what we do. 0.8 times 10% plus 0.2 times 20%. And then your expected portfolio return is 12%. Yeah, and here you can see it shifts on depending on where you invest. We invest 80% in one, here 10%, only 20% in 20. So the expected return is for sure closer to the 10% than it is to the 20% because we invest more into this asset. Yeah, so that's why our expected return will be 12%. If we look at our portfolio risk, the formula is a bit more complicated. I write it down first. Okay, so what do we have here? we have the square root of the weight 1 squared times standard deviation squared plus the weight 2 squared times standard deviation 2 squared plus 2 weight 1 times weight 2 rho. That's your correlation coefficient. Correlation coefficient 1 and then standard deviation 2. Yeah, so that's your formula. So we type in again the things that we got. 0.8 squared times 0.16 squared. 0.16 is the standard deviation here, as at 1, plus 0.2 squared times, what is it here, 30%, 0.3 squared plus 2 times 0.8 times 0.2 times, this is our correlation coefficient, we said it's 0.8, times 0.8 times again 0.16 times 0.3, and then we take the square root of everything, and then our result should be approximately 17.96%, which is your new portfolio risk measured by standard deviation. Let's do the following. Let's look at how the portfolio return would look like if we assume a new correlation coefficient. Let's use 0.2 instead of 0.8. As you can see here, for the portfolio return, we are not using our correlation coefficient. It does not impact, so the portfolio expected return is exactly the same, 12%. If we look at our portfolio risk, then the formula would be basically the same, except we would change this number with 0.2 instead of 0.8. So if we type in the same numbers plus 0.2 instead, then basically this part here will be a bit lower than when we used 0.8, which means our standard deviation in this example is 15.18%, because this part here under the new scenario with 0.2 is lower than what we had before. This one here is exactly the same as before because you're not using our correlation coefficient. If we introduce a few other correlation coefficients, let's say we go from 0.8, 0.2, we go and then we go to -2 and minus, then what you would see, the corresponding risk for each, this is your correlation coefficient, and this is your risk. We had this before, 17.96%, 15.18%, 14.14%, 13.00%, 8.77%. And you can see here, the lower your correlation coefficient, even especially if it moves in negative directions or in opposite directions, then you achieve very high diversification. So lower correlation reduces overall portfolio risk, with the lowest risk in our example with minus 0.8. Negative correlation provides very strong diversification benefits, and the expected return in our example remains constant as 12% because correlation only affects risk, not return. Thank you so much for listening. I hope you found this useful. I see you in another video. Bye bye.